All right, thank you for joining us. Here we are, another live video. It is May 7th, 2023. Can you believe we're almost halfway through the year? So we were out in Riverside today doing homes. We're going to talk about that. We're going to talk about the market. What we're going to talk about: foreclosures. We're going to talk about the commercial market. We're going to talk about interest rates. I don't know, all kinds of things. So appreciate you joining us. If this is your first time in the channel, welcome. We make videos that are everything Southern California. Southern California, we have Southern California. We make videos on living, eating, playing, working in Southern California, naturally owning a home, owning a business. We make a lot of videos. We're going to keep making a lot more. We love the live videos. Hi, my name's Bruce Clark. I'm a professional real estate agent with Coldwell Banker in Newport Beach. Been doing this almost going on 17, 18 years now. Wow, time flies. So whether you're looking to buy, sell, move, invest, give me a call, shoot me a text, send me an email. We'd love to help you. And our contact information is below. So a few things. So foreclosures, we're seeing for the past couple of years, we've seen an increase in foreclosures. We haven't seen a tsunami, and I'm going to come back to that. I want to talk about pricing, because pricing's still crazy, certainly in Southern California. So in between February 2022 and February 2023, there was approximately throughout the country a 21% increase in pricing. Naturally, that's not sustainable. So when people talk about a decline in price, I my home is worth $1 million. 2 years ago, it was worth $600,000. So that it becomes a reality in a sense, because your neighbor's getting that, and there are people down the street. But is it really $1 million? Now, homes are always worth what someone's willing to pay. That's the defining factor of the value of any asset, whether it's crypto, whether it's painting, whether it's a Rolex watch. So it's whatever someone was willing to pay. So, but coming back to pricing, as we go throughout Southern California, there's some areas we go to and we look at these prices, and it's incredible. We for under $800,000, you really can't buy in Southern California. It's my producer, my wife, signaling. It's very difficult to buy, certainly a single family home in the area for she's also my assistant. No, she's my wife. Great baker too. Eric, our son, 12-year-old son, used to call mommy the world's best cooker. But pricing, it's interesting. Is that home really worth $1 million? People are paying it right now, but is it really worth that? We saw such rapid appreciation, and one of the things that we saw was the CDC. They came in and said, no evictions, basically no foreclosures, no anything, which was odd, because it's just, there's an unelected person that made that capricious decision, and everybody went along with it. I think that's incredibly poor governance. I think, separation of the branches of government are critical to the proper functioning of any, certainly, republic. But here, Rochelle Walensky came and said, hey, you can't evict, you can't foreclose, you can't do anything. And she is the director of the CDC, who's, I guess she's leaving her post. So Center for Disease Control. So the CDC. And that really, really set in motion what we're seeing what's playing out today in the commercial market. And I'll come back to that. But when it comes to foreclosures, when it comes to pricing, so there weren't enough homes in the market because we had the lockdowns. So the homes that were on the market were being bid up. So it was artificial. Now, has that artificial become permanent? In the sense it has. We see it played out in some areas where someone's willing to pay for whatever reason a premium. Maybe it was a home they grew up in. Maybe they liked the lot. Maybe they liked the location. But it's interesting because that one home can definitely skew the market dramatically one way or the other. We've seen it. We're going to see that in commercial in San Francisco. Right now, they're looking at 30 to 50% vacancies. So the next time a property trades hands there, and commercial transactions are down dramatically. The next time a property trades hands, it's going to trade at a much lower value than expected, certainly over the past 2 years. So you're talking about some buildings. Some buildings trading at, well, they were in the market for almost 300 million, and trade probably in the 50 million. So you're talking about just a monster decline. I mean, we're talking about huge. Now, these are buildings that are, for all intents and purposes, in between 30 to 50% vacant. I alluded to this earlier, and I alluded to it when cell phone traffic, this is a leading indicator. Cell phone traffic in San Francisco, in downtown San Francisco, is down 69%. So you're taking away all the attorneys and all the the bankers and people who love to talk, real estate agents, preachers. My dad was a Methodist minister, and they can talk. But so the people that are doing commerce electronically, they've been removed, so to speak, from that town square. And we've seen it played out in that. We've also seen, of course, all the foreclosures and evictions down there. Nordstrom is leaving San Francisco. They're closing the last 2 stores, a Nordstrom and a Nordstrom Rack, because of people are afraid. Number one, crime. Number two, people just aren't coming in the office. So those that were coming in the office, those who are not coming in the office, are not going to be able to shop at a Nordstrom and Nordstrom Rack. So all of that coupled, of course, just getting huge crime. And, it's shoplifting. Goodness gracious, it's out of control. But that is going to play the commercial. So let me come back to residential. So we had this artificial inflation. And if we saw even a 20% decline in pricing, it still would have been a very good 2 to 3 years for people. Is that going to happen? It remains to be seen. But let me tell you what some of the things the government's doing. So loan level price adjustments. One of the things they're trying to do is they're trying to increase home ownership by incentivizing people with, if you have a lower credit score, you're going to pay less of a premium fee for pricing of a loan. If you have a higher credit score, you're going to pay more. And they used to be top tier pricing was 740 on a FICO, Fair Isaac FICO. And so now it's 780. So they've made it more difficult for people with really, excellent credit. 740 and above, you're gold. So now you have to be 780. That's going to take some people out of that premium pricing tier, so you're penalized. But if you're under 640, you're going to be able to get a discount, so to speak. So it's going to be interesting. It's going to be interesting to see how the loan level pricing adjustment plays out. FHA, they've come out with some loan modifications, and they have a 40-year loan mod, 40 years. Now, if you're behind on your mortgage, what's going to happen is they say, hey, you can keep it. I'll keep you in your house. However, they're going to reset a lot of things. Any late fees, all kinds of things. They're going to pack attorney's fees. They're going to pack all of this into the loan, and then they're going to say, hey, we're doing you a favor. Now, I hate evictions. I hate foreclosures. I had to go through them. I've seen people that have lost their homes, and it's painful. It's painful personally to see. But here's the thing. If you keep someone in a home and you make it a 40-year and you've packed all these extra fees in, and that home now becomes much more expensive. Yes, you're going to save some on the payment. What happens is you might not ever get to pay that home off. Here's what happens when you refinance a loan. You go from a non-recourse to a recourse loan. And what that means is this. As a non-recourse is, God forbid, something happens, you'll lose your home. They foreclose on you. Again, this is not legal, tax, financial advice. Consult with your trusted advisors on that. This is real estate. But a non-recourse loan is they can't come back to you for that deficiency, for what's called a deficiency judgment. When we did short sales, we had those. We used attorneys I negotiated my first short sale, decided that it made no sense. It was a legal issue. And so we brought in attorneys, we had CPAs, and we had professional negotiators that worked those, because we felt it was as fair to have professionals on all sides working on behalf of our clients. So what happened is, let's say that your loan was $1 million. Your loan was $1 million. Your house is worth $600,000. Theoretically, you had your loan was $1 million. Your house is worth $600,000. You had a $400,000 gap, so to speak. And so, if the home was sold, it was sold for $600,000. You would then theoretically get a deficiency judgment in the amount of the $400,000 of forgivable loss, the loan amount. So that was negotiated for there not to be a deficiency judgment, and that is non-recourse. Non-recourse is if you lose your home, it can't come back to you for the difference. Now, a recourse loan, when you refinance, you reset the clock. Refinances don't always make sense. And people are saying, well, I'm going to save $94 a month or $180, but what happens is you reset the clock. You reset the amortization schedule. That can be the worst thing for you to do. Consult with your professional tax, legal, financial advisors, your mortgage experts. Let us know if you need anybody in any of those areas of practice, please. But what happens is you've reset. So for, let's say, 9 years, you've been in your home now for 9 years, and now you're starting to pay some principal. What happens is when they reset the amortization table or schedule, you go back to paying the front end load for 7 or so years is pretty much all interest. You're back to it. So you paid for 9 years. Now you're getting the principal. Now they throw you back and say, hey, no, we want you to reset, and it's going to be a recourse loan, so we can come after you legal. I mean, it really muddies the waters for many people. Is it the last course of action for some, last recourse before losing a home? Perhaps. But we always, we encourage people to go get professional financial counseling, and there's a lot of different ways and things you can do. There's equity share programs. There might be someone that's willing to participate with you, loan you some money, take a second or a third if you have, 1 or 2 loans. But there's a lot of different ways, so saving a home, we think saving a home is important. But watch refi. So anyway, back to FHA. They said, hey, we're going to refinance you, put you in a 40-year loan. Now in Canada, they have 50-year loans. That does not solve the inventory problem. That does not solve the affordability problem for the most part. You're just saying, forget the price of the home. We want you to overpay in some cases. We're just going to stuff you into this super long loan, and your payment's going to be, quasi-affordable. For some, that's going to make sense. For others, not. That's why we talk about if you do a 30-year and you make an extra payment, you come down to 21 years on the loan, and 21 years from now you own your home free and clear. But you don't always want to own your home free and clear. Well, again, that's where your tax advisor comes in. We do recommend that people, when you have equity, you look at deploying that into other things. If your loan's at 5%, you can make 9% in an investment, then it makes sense. For many, again, consult with your advisors. So that is on. So that's the loan level price adjustment. We talked about refis. Pricing wise, we've got some foreclosures. We've seen some bank owned homes are coming up. On the commercial side, it's getting hit hard. It's going to continue to get hard. The Fed raised the Fed Funds Rate again. It's the highest since 2007, which is crazy. August 2007. We've also seen this is, I guess, like their 10th raise. It's about double. They're still looking at a 2% inflation target, and they want to continue to raise the Fed funds rate. That's what the St. Louis Fed, gentleman at St. Louis Fed says. I just don't know if that's going to be possible. There's not a lot of levers the Fed has. They can't keep throwing money. We're so far in debt. So it's going to be interesting. Having the loan mods and 40-year loan mod and all those things certainly plays in. The pricing of homes, Today we were out in Riverside, and we sold a home here in Irvine not long ago, and it was just crazy, the amount of traffic, the amount of people. We set a pricing record, and we're out in Riverside County today, and as we're going to homes, there were still a line of people. These homes right at $500,000. That's where our buyer. So the price out of Orange County. There's some nice homes for $500,000. In the past, you could buy in Corona, what's in Riverside County. Now you're in Jurupa Valley, Jurupa. Now you're in Riverside. It's Jurupa. And again, people are moving farther out. But what I'm saying is the pricing is still just kind of out of the pricing is still high because we don't have the inventory. It's not a sales problem, it's an inventory problem. We looked at 6 homes today, and all of them are probably going to have multiple offers. Some of them need a lot of work. But the pricing, so we're starting to see some decline in pricing in various areas. We're seeing some in Idaho. We're seeing some in Idaho. We've heard about some things in Michigan. We've heard about certainly Chicago, that area. Down in Phoenix, we've seen Las Vegas is still good, is going to be hit. But from a pricing perspective here in Orange County, we're up about 3%. We'll be up about 3% this year. And if again, inflation right now is 5.5 to 6%. So the expectation is a good return is a rate of inflation plus. So for housing appreciation to keep pace, we're going to probably have to see about 7 to 8% appreciation this year. $1 million home is now $1.080 million. Compound interest $1.080 million. Then you're $1.2 million basically next year. Are we going to see it? Not certain. We're not seeing lessened demand. We're seeing lessened supply. Sales are being impacted simply by the lack of inventory, and it's certainly not the rates. People have adjusted to the rates. I think most people have adapted and their budget and everything. But again, if you're in a 3% loan and you're looking to go in a 6% loan, you're adding on some additional debt, it might not be tenable. It just might not work for you. It's going to be interesting. I'd love to know I'd love to know your thoughts on this. I do have people that are investing in all kinds of different things, and so we're following. One last thing I want to talk about, and everybody's this is all the rage. Everybody says, "Hey, we have all this. We have 8 billion square feet of office space here in America. Let's repurpose it. Let's convert it to residential." Well, here's the thing. Last year, there were 22 projects in all the country that were completed. Now, there's over 200 right now that are in the planning stage, but it's incredibly expensive, incredibly time-consuming to repurpose a building. It's not simply we're gonna throw up some additional. We're gonna throw some drywall and beams, et cetera, and off you go. It's not that easy because you've got plumbing, you have the electrical, of course, you have the structural, and it might not ever be able to be repurposed based on the structural engineering. And you have geological. It simply might not be possible. Then you have things like capabilities of the sewer system, the septic. It might not be able to absorb all the additional traffic that's being generated from toilets and bathtubs and things like that. But there aren't that many repurposing projects going on. And I know some people have been involved with some. And the word of caution is if you haven't done it, it's you have to go through one, I guess, to experience it. But and I'm talking more to the commercial people now. But it's going to be interesting. I'd love to know your thoughts on the repurposing of building, what you're seeing from a municipality standpoint here in California. They're encouraging people to go through that. They're encouraging accessory dwelling units. They're looking at probably splitting some parcels with the primary and ADU and maybe another ADU. They're trying to do all kinds of things there. And it's going to be interesting to see what they do there. But they would love to take a 40-story. So they would love to take a 40-story building and make, let's say, 320 luxury condos. Whether or not that's feasible at this point, I don't believe it is for most buildings. But I think that the state of California, I see them really promoting that. And it's going to be interesting if there's, for example, there's special economic opportunity zones, and we see that in some areas, and then there's great tax advantages. Will the state of California or will the government, will they incentivize people to repurpose buildings? It's going to be interesting. Huge, huge, huge money though, huge. Who's going to finance it? Traditionally, it would have been your regional bank. It would have been the Republic Nationals or PacWests. They're not anymore because they're no longer in existence. Republic National was absorbed by Citi. Wow, what a deal for Citi. PacWest, Pacific West, the rumor is this week is going to be taken over by the FDIC, by the feds. And regional banks have been the traditional funders of development projects, of commercial projects, and they're going away. Where all the money's going to the money center banks, Citi, Chase, Wells, B of A, US Bank, those. So, but the thing is, there are going to be less and less banks lending, period. And we see that. We see that reflected. Citibank is offering 0.5% on as a savings rate. But you can get 4.5%. At a smaller bank, you could probably get 3.5% at a credit union, whether it's a Westcom or along maybe Federal and Penn Fed for military. Then you've got USAA as a savings bank. I mean, you've got all kinds of institutions. You got some local banks, which also are very, very competitive. Citi doesn't need to be. That's the thing. And as they get bigger, probably going to be less competitive for savers or people that are, and certainly credit cards and things like that, because they're going to have such a hegemony on the market. But I see that happening. Going to be interesting. I'd love to know what your thoughts on this. Where do you see the commercial going in your area? We're still seeing a lot of vacancies here in Orange County as we drive around. We still see a lot of vacancies for the commercial. We see lots of restaurants. So I'd love to know what you're seeing. I love the macro view. At the same time, real estate's location. So the micro is important for what I do in the residential. What are you seeing? Share with us. I appreciate you joining us. Bruce Clark, Coldwell Banker. Whether you're looking to buy, sell, move in the next 5 days, 50 days further out, give us a call. Shoot us a text, send us an email. We'd love to help you make a move to Orange County, Los Angeles County, San Diego County, San Bernardino County, Riverside County, or if you're looking to sell. We'd love to hear from you too. Have a good rest of the weekend.